Just want to talk about mortgage structuring that could save you thousands of dollars and help you better manage your money. Specifically, I want to talk about why offset mortgages can be a better choice compared to a revolving credit facility. So let's just start with a revolving credit facility and how they work. So it's essentially a floating rate loan that works like an overdraft facility. Everything sits within one account and you only pay interest on the amount you've borrowed. When you have spare cash, you park it in that account, which reduces the balance you're then paying interest on. So in principle, it works great, and it does work really well for lots of people. However, there is a significant challenge I see with revolving credit facilities. Because it's essentially a spending account, people often find themselves dipping in and out of it for various costs. And it can create a messy situation where different types of savings get muddled together in the same place. So let me just give you a real example. You might have some travel savings, you might have an emergency backup fund, or if you're self-employed, you might have some tax savings set aside as well. So with revolving credit, it makes sense to put all of those in the one account. But this means you need a separate system to track those different savings buckets. Otherwise, you risk accidentally spending your tax money on a holiday or dipping into your emergency fund for just everyday costs. So this is where an offset mortgage works really well. So it's the same principle as a revolving credit. You have a floating rate loan, but here's the key difference. You can link multiple bank accounts to that loan. Some banks allow up to say 25 accounts. So using my earlier example, you could have your normal transactional account plus separate accounts for say emergency funds, travel savings, and tax savings. All of these accounts add together to offset that loan balance, but still remain clearly separate and labeled with names. So this offers some good advantages. So first, you get much better oversight of your money because each savings goal has its own account. And secondly, these offset accounts typically aren't linked to an EFTPOS card, which creates a natural barrier to just say impulse spending. And most importantly, you're benefiting from saving 5 to 6% on the floating rate interest instead of say earning 2 or 3% on a savings account. And remember, the savings account earnings also get taxed, so the real return is actually lower than that. So the bottom line is this: if using money you already have in your accounts to offset your mortgage is a smart financial strategy. I believe the offset structure does it a bit better by allowing you to split your money into different buckets while still getting the full benefit against your loan. If you're thinking about a revolving credit or considering your mortgage options, it's just worth exploring whether an offset mortgage might work better for you.